This conversation is powered by Google Illuminate. Check out illuminate.google.com for more. Welcome to this discussion on a fascinating section of the Federal Reserve Act. We'll be diving into Section 23, Interbank Liabilities, a critical piece of legislation designed to safeguard the financial system. It's a complex topic, but our guest is here to break it down for us.
The core aim of Section 23 is risk mitigation. It's about preventing the domino effect, the collapse of one large institution, from triggering a wider crisis.
Exactly. The potential for systemic risk is a major concern. Can you elaborate on how this section addresses that?
It does so by limiting the exposure of insured depository institutions to other depository institutions. Think of it as a carefully calibrated system of checks and balances.
So it's not just about preventing a single bank failure, but about preventing a cascade of failures. Let's define exposure as it's used in Section 23. The text mentions several types of transactions.
Correct. Exposure encompasses a wide range of financial interconnections. This includes direct extensions of credit, like loans, but also indirect exposures, such as deposits held at another institution, purchases of securities with repurchase agreements, guarantees, and letters of credit. It's a comprehensive definition.
And the attribution rule is particularly interesting. It essentially says that even if a transaction isn't directly with another depository institution, it's considered exposure if the proceeds benefit that institution.
Precisely. It's designed to prevent circumvention of the regulations. If a bank lends money to a shell company that then transfers the funds to a risky institution, that's still considered exposure under Section 23.
The section grants the Federal Reserve Board authority to set aggregate limits on exposure. How does that work in practice?
The board uses regulations and orders to establish these limits, tailoring them to the specific risks involved. They consider factors like the size and financial health of the institutions involved. It's a dynamic process, constantly adapting to changing market conditions.
And there's also a provision for exemptions. What are the criteria for granting an exemption?
Exemptions are granted only if the board determines they are in the public interest and consistent with the overall purpose of the section. This is a high bar, ensuring that any exemptions don't undermine the core goal of risk reduction.
The definition of insured depository institution is crucial. How does that tie into the FDIC?
This section explicitly links the definition to Section 3 of the Federal Deposit Insurance Act. This ensures consistency and clarity in applying the regulations. It's about protecting depositors in insured institutions.
And who is responsible for enforcing compliance with these regulations?
The appropriate federal banking agency enforces compliance, leveraging the authority granted under Section 8 of the Federal Deposit Insurance Act. This ensures a robust enforcement mechanism.
The board has broad rulemaking authority under Section 23. Why is this flexibility important?
The financial landscape is constantly evolving. New financial instruments and transactions emerge regularly. This flexibility allows the board to adapt the regulations to address emerging risks and maintain the effectiveness of the section.
Let's circle back to the overall purpose. Why is limiting interbank liabilities so crucial for financial stability?
It's about preventing contagion. If a large institution fails, its interconnectedness with other institutions can amplify the shock, leading to a cascade of failures. Limiting this interconnectedness is a key strategy for preventing systemic crises.
The text notes that this Section 23 replaced an earlier version. Does that tell us anything about the evolution of regulatory thinking?
Absolutely. The fact that the section has been revised reflects a growing understanding of systemic risk and the need for more comprehensive regulations. The earlier version likely proved inadequate in addressing the complexities of modern financial markets.
What are some of the practical implications of Section 23 for banks and other financial institutions?
Banks need to carefully manage their exposure to other institutions, regularly monitoring their interconnectedness and ensuring compliance with the board's regulations. This requires sophisticated risk management systems and internal controls. Non-compliance can lead to significant penalties.
Does this section impact the lending practices of banks?
Indirectly, yes. By limiting exposure, it encourages banks to diversify their lending portfolios and avoid overconcentration of risk with any single institution. It promotes a more cautious and prudent approach to lending.
Given the ongoing evolution of the financial system, do you foresee any future changes or refinements to Section 23?
It's likely that the section will continue to evolve to address new challenges. The rise of fintech and other innovative financial technologies may require adjustments to the regulations to ensure they remain effective in mitigating systemic risk. The board will need to remain vigilant.
What is the overall role of the Federal Reserve in maintaining financial stability in light of Section 23?
The Federal Reserve plays a crucial role in overseeing and enforcing the regulations under Section 23. Their ability to set limits, grant exemptions, and monitor compliance is vital for maintaining the integrity of the financial system. They act as a crucial safeguard.
How important is transparency in the application and enforcement of Section 23?
Transparency is paramount. Clear and consistent application of the regulations builds confidence in the system. Public understanding of the rules and their enforcement helps to maintain market stability and prevent misunderstandings.
How does Section 23 fit into the broader context of financial regulation in the United States?
Section 23 is just one piece of a larger regulatory framework designed to promote financial stability. It works in conjunction with other regulations aimed at capital adequacy, liquidity, and risk management. It's a coordinated effort.
Let's return to the core issue, systemic risk. How effective has Section 23 been in mitigating this risk?
Assessing the effectiveness of Section 23 requires a nuanced approach. It's difficult to definitively say it has prevented a specific crisis, but its existence undoubtedly contributes to a more stable financial system by limiting the potential for contagion. It's a preventative measure.
Are there any limitations to the effectiveness of Section 23?
Like any regulatory framework, Section 23 has limitations. It's not a panacea. Rapidly evolving financial markets and innovative financial products can always present new challenges. Continuous monitoring and adaptation are essential.
So in summary, Section 23 is a vital component of the regulatory landscape, aiming to prevent systemic risk through the careful management of interbank liabilities.
Precisely. It's a dynamic and evolving piece of legislation that requires ongoing monitoring and adaptation to maintain its effectiveness in a constantly changing financial environment.
That was a great discussion. Thank you for your insights.